So welcome back to another of my introductory videos. This time I'm going to be talking to you about audit risk. Now, audit risk is a very important thing for auditors to assess. Audit risk essentially is a risk that the auditor is going to face that there is a potential material misstatement within the client's financial statements. Okay, so auditors need to know how to manage this risk because otherwise they may get sued, or they may be punished by the PCAOB, or they could lose reputation. Okay, so the design of audit tests depends very much on how auditors assess the risk and the components of audit risk. The objectives for today's class are as follows. Firstly, you should be able to explain the components of audit risk. Okay, so the three components are inherent risk, control risk, and planned detection risk. So you should be able to explain what those are and what they mean. Secondly, describe the main limitations of the audit risk model. And we have a student presentation that will help us to do that. Third, explain the key factors affecting an auditor's assessment of inherent risk. And what are the key factors affecting an auditor's assessment of control risk? And then finally, you should be able to describe the main limitations of internal control systems. Okay, so the seminar outline for today's topic on audit risk is shown here. These are the objectives that I've just talked about. In preparation for this class, you should look at the class questions and the student presentation that are in this seminar outline. Also review this video. The third item on your reading list is chapter 9 from the auditing textbook. That's not required, that's recommended. Also the auditing standard on audit risk, consideration of materiality in planning and performing an audit. Okay, again, that's recommended reading, it's not required reading. Okay, so what you're required to do basically is read through this seminar outline and view this video. For the students who are giving the presentation, there are 2 additional readings here, 6 and 7, which will help you answer the questions on the presentation topic. Okay, so the questions that we're going to go through in today's class, the first one is about segregation of duties. So in particular, I want you to explain to me why operating responsibilities should be separated from accounting, why custody of assets should be separated from accounting, and why custody of assets is separated from the authorization function. Okay, so that all has to do with evaluating internal controls. Question 2 is about how slow-moving inventory would affect your assessment of different components of audit risk. So how would it affect your assessment of inherent risk, control risk, audit risk, and planned detection risk? Question 3 is a question about auditor detection risk. So you're given a scenario here, and you're asked to comment on the appropriateness of the work done, the conclusions that were drawn by the auditors, and recommend the right course of action. And then to finish off, we have some multiple choice questions. Okay, in addition, we have a student presentation about audit risk. There's some articles to help the students with this topic. The first one is about the financial reporting failure and audit failure that occurred at WorldCom. So we'll be thinking about whether the audit risk model could be applied to a company like WorldCom and what the potential pitfalls would be in doing so. And then there's this article from CFO.com, which talks about how accounting researchers try to help practitioners in identifying suspect accounting. Okay, and there are a couple of readings on your reading list that will help you to do that, that's related to this article. So the questions for the students to consider in this presentation are: what are the limitations of the audit risk model in practice? What are the economic incentives for an auditor to reduce risk to an acceptably low level? If you applied the audit risk model to a company like WorldCom, what do you think Anderson's risk assessment should have been, and how would this have affected the evidence Anderson would need to collect? And then finally, what are the warning signs that a client's financial statements could be materially misstated? Okay, so that's the seminar outline. Let's make a start in thinking about what audit risk is and what are the components of audit risk. So audit risk is a risk that the audit opinion is unqualified. In other words, the auditor says that the financial statements are fairly presented, when in fact the financial statements are materially misstated. So you can think of audit risk as being the risk that the auditor issues the wrong opinion. The auditor gives you an opinion that the financial statements are fairly presented, but in fact they're not. They're materially misstated. Now you can think of audit risk as like a probability, right? So it varies from 0% to 100%. So an audit risk of 100% would mean that there's definitely a material misstatement in the financial statements and the auditor has given an unqualified opinion. Okay, so that means there's definitely an audit failure, in other words. When audit risk is 0%, that means there isn't a material misstatement, definitely isn't, and the auditor has given an unqualified opinion. So this is a case where the auditor has definitely not committed an audit failure. Okay, but of course in reality audit risk is not ever going to be as low as 0, and it's not going to be, generally speaking, as high as 100%. Okay, so auditors need to assess where audit risk is, right? How close is it to 100%, or is it close to 0%? And you can think of audit assurance as just being the complement of audit risk, or in other words, 1 minus the audit risk. So for example, if audit risk is 10%, then that would give us audit assurance of 90%, right? 100% minus 10% would be 90%. So in that case, if audit risk is 10%, that means there's a 10% probability the financial statements are materially misstated and the auditor gave an unqualified opinion. But on the other hand, that means that the level of assurance is at 90%, because there's a 90% probability that there isn't a material misstatement, and so the auditor has given the correct unqualified opinion. So that's what audit risk is. What are the components of audit risk? Well, there are 3 components. The first one is inherent risk. Okay, so inherent risk refers to the risk of errors occurring in the client's financial statements. Okay, so inherent risk is driven by factors that are not under the control of the auditor, but which may affect the risk of an error in the client's financial statements. So for example, if the client's management have pay that is very strongly linked to reported sales and reported profits, then that means there's more likely to be a misstatement, right? So anyway, I'll talk later about the factors that affect inherent risk, but essentially they're factors that auditor cannot affect, right? They're driven by the type of industry the company is in, the incentives that the company's management have, things like that. The second component is control risk. And so controls refer to the idea that the client should have controls in place to try to reduce risks from occurring. Okay, so control risk is essentially the risk that the client's controls do not prevent a material misstatement from occurring. All right. So if you think of these errors as like water flowing through a pipe, as shown here, then the internal controls are essentially trying to capture or prevent those errors, but not all of the errors will necessarily be prevented. There may be some errors that bypass the controls. For example, it could be that there's a transaction that doesn't go through the normal control procedure because it's a one-off transaction. Or it may be that management override the internal control system. Okay, so you can have these reporting errors that simply don't go through the controls, or you could have transactions that do go through the controls, but for whatever reason, perhaps human mistakes, they're not detected by the controls. Okay, so you've got these errors that most of which are going to be captured by controls, but you've got some that are not. And then the role of the auditor is to try to detect those that are not detected and prevented by the client's control system. So then you've got this second safety net, if you like. You have the auditor trying to detect errors, but then the auditor is not perfect. There could be some errors that are undetected by the auditor. And so the risk of these errors occurring down here is what we know as audit risk, right? So this is the risk that there could be a material error in the audited financial statements. So that's a helpful way to think of reporting errors occurring. Inherent risk essentially is the flow of errors that could occur due to the client's economic situation, the incentives that management have. Controls are there to try and prevent these errors, but controls are not perfect. Then auditors are there to try and prevent those errors or detect those errors that haven't been prevented by the control system, but then you're still going to be left with some errors. And so the risk of those errors being material is audit risk. Okay, so the audit risk model is as follows. On the left-hand side, we have acceptable audit risk. And then we have the three components of audit risk, right? Inherent risk, control risk, and planned detection risk, PDR. So the idea here is that the auditor chooses an acceptable level of audit risk, and that will depend on what the auditor is willing to tolerate, okay? So the two main factors that will usually affect an auditor's acceptable audit risk are firstly the demand for audit assurance by financial statement users. Okay, so if I go back to my previous diagram here, the idea here is that, you know, if there are lots of financial statement users out there that really depend on the auditor, then you really want to have as few of these errors as possible. Okay, so that means that you're going to set acceptable audit risk to be very low, right? You don't want many of these drops to occur. But if you're auditing a client where there are very few financial statement users, then you may decide that you don't need to have such high audit assurance. So you may be willing to tolerate more errors occurring. Okay, so that's the first thing. And then the second determinant of acceptable audit risk is the auditor's business risk. And what we mean by business risk is the loss that the auditor may face as a result of a material misstatement. So that loss could occur because the auditor is being sued, or the auditor loses reputation. For example, if the material misstatement is discovered on the television, in the news media, in newspapers, and it's going to damage the auditor's reputation. And then thirdly, it could be that the auditor is sanctioned by the PCAOB, right? It could be punished for allowing the material misstatement to occur. So the risk of the auditor suffering loss as a result of a misstatement is what's known as the auditor's business risk. Okay, so if the auditor's business risk is high, for example, if you're auditing a publicly traded company, then you have the risk of being investigated by the PCAOB, then you would set acceptable audit risk as lower. If you're auditing a private company, you're not subject to regulation by the PCAOB, then you may be willing to tolerate a higher business risk. Or rather, business risk is lower, so you're willing to tolerate a higher audit risk. Okay, so generally speaking, acceptable audit risk would be low for a large publicly traded company because there's a greater risk of reputation loss, there are more financial statement users, there's a greater risk of litigation. Whereas if you're auditing a small private company, there are fewer financial statement users, less likely to lose reputation, and less likely to be sued. Okay. So that's what determines acceptable audit risk. So the way this works is that the auditor first assesses the client's inherent risk and control risk. And the product of these two essentially is the risk of a material misstatement in the unaudited financial statements. So in other words, before the auditor has done any testing, the risk of a material misstatement in the client's financial statements is IR times CR. Or if I go back to this diagram here, if you imagine that the auditor has not yet started the audit, then the risk of a misstatement in the client's financial statements is IR times CR. right? Because you have these errors that are flowing out the pipe here. Some of those errors are caught by the controls, but then the rest are going to be in the client's unaudited financial statements. And then it's only then that the auditor comes in and tries to detect some of those errors in the unaudited statements. Okay, so the risk of a misstatement in the unaudited financial statements is IR times CR. So then given IR times CR, the auditor then sets PDR to ensure that audit risk is no greater than the auditor's acceptable audit risk. Right, so let me give you an example to make this more concrete. Suppose that the auditor chooses acceptable audit risk to be 1%, and suppose the auditor assesses that IR times CR is 20%. So what does that mean? That means that the risk of a misstatement in the unaudited financial statements is 20%, but the auditor wants to reduce that risk to 1% in the audited financial statements, right? So the auditor needs to reduce risk from 20% to 1%. So to do that, the auditor has to make sure that plan detection risk is no greater than 5%, right? It should be less than or equal to 5% to ensure that audit risk is less than or equal to 1%. So in other words, 5% times 20% takes us down to 1%. Okay, so that's where I will finish the video for today. Where we will start in the class is with the student presentation. So the students are going to be talking to us about the limitations of using the audit risk model in practice. What are the economic incentives for an auditor to reduce audit risk? How would you apply the audit risk model to a company like WorldCom? And then what are the warning signs that a client's financial statements could be materially misstated? Okay, thank you for watching the video.